So this is a question on depreciation. You bought some shelves and racks costing 8,000. They were purchased on 1st Jan. They are useful for 10 years and a scrap value of 1,000. So this one is whenever they give you this information, useful life, scrap value, the only way to calculate depreciation is using the formula cost minus scrap divide by useful life. So that's the depreciation for the year. Okay, and you will use it to record your depreciation expense for every year because this is a fixed formula. So every year of its lifespan, you will charge the same depreciation, and the date that you will do that will be at the end of the financial period, which is 31st December. The double entry is always debit depreciation expense, credit accumulated depreciation, and the amount will be the amount that you calculated. Part A also asks whether using the straight line or reducing balance is more appropriate. So this is dependent on the usage pattern. So for shelf and racks and other fixture and fittings, where you use the same way every year, the benefits are the same every single year. It is more appropriate to use the straight line method because it assumes that the benefits are equal over the life of the shelves and racks. So for question 12, we received some financial information from his books. So we have office equipment costing 25K and accumulated depreciation. This represents the balance brought down at the start of the year, which means that the office equipment is not newly purchased. It has been used for some time. So because there's some accumulated depreciation. And then at the end, towards the end of the year, on October 1st, they bought another piece of new equipment costing 6,000 on credit. So you are using the 20% using the reducing balance method, and you want to calculate the depreciation for the year. So it's very important that you see the second piece of equipment separate from the first one, the original ones. Okay, so if we were to separate their depreciation, the old ones we will use 20% times the net book value, which is 25,000 minus 9,000. Okay, this is our depreciation for the old original equipment. And then for the new one, we are going to take 20% times 6,000. All right, this will give us for the new equipment. Then we need to add both of them together so that we can get the depreciation expense for the year. So just be careful when they buy a new one, just break them apart and then combine the calculation together at the end.